Stephen King, CEO of GrowthForce, and welcome to Put Your Numbers to Work podcast. I'm really excited to be joined today by Art Saxby, a good friend, a client, and the CEO of one of the best marketing companies in America, Chief Outsiders. Welcome, Art.
Well, thanks for having me.
Tell us a little bit about what Chief Outsiders does.
Chief Outsiders helps drive engines for growth at companies. Most mid-sized companies do a very good job of running the business. The CEOs really understand the process, the procedures, how to run the business. They love their thing. But there's struggle now and then when it comes to growth. How do they drive the company significantly forward, maybe in different directions, in different ways? So we work with the CEO to understand their vision and then bring in a resource, a chief marketing officer, someone who can help bring in a market-based perspective, act as part of their management team to help drive that growth forward. Really create an engine for growth that's going to continue driving growth on and on and on, into the future. Not sell an ad campaign or a strategy deck, but bring in a chief marketing officer that they could never really attract, don't need forever, but someone on their management team for this important period of time to help implement growth.
So it's an outsourced CMO.
Yep.
That sounds great. And we've known each other a long time, right? We both started our businesses at the exact same time, right?
Really? I thought you were ahead of me, but...
Well, maybe, a couple of months, but we met in, and the reason I wanted to ask you to be on the show was, this is about finding the people I admire who are really good at managing their numbers. And when we first met, I remember it was at a networking event, and at the end of it, I think you said somebody told me to come see you. I'm starting a company and I need to set up QuickBooks, right? Is that your recollection?
Absolutely.
And I remember being so impressed by the kind of the data you wanted, the analytics. You really said, I want to set this up right. And GrowthForce has got a reputation for that system side. So what I didn't realize though was that you have an MBA in finance.
A bachelor's and an MBA in finance.
A bachelor's and an MBA in finance. So that's maybe why we got along so well.
Exactly.
We're speaking the same love language. And we started as a client and we set up your QuickBooks file. And I remember one of the first things you said is, I'd like to be able to see what's the profitability of my marketing campaigns. If I'm going to do this as a business, I need to show my clients the ROI that they get from hiring you as an outsourced CMO. So I want to do that for myself. Can you do that? And we set up a job type field in QuickBooks as a drop down with your lead sources. And then, years later, you sent us an email saying, I need to evaluate something. Do you tell us about how do you use that data?
Well, it's surprising. It really goes back to my background in finance. Doing financial forecasting, financial analysis for major corporations, Frito-Lay, and such. I realize that one of the biggest challenges companies have, large and small, is understanding where profit comes from.
Right.
They know where revenue comes from. Hey, this is our biggest client. They know who sales likes to sell to. They know the products like manufacturing likes to make. Mm-hmm. They know who buys the most. They know who's the highest price. But the most profitable is a very different answer. Mm-hmm. And this business game is really a profit game. That's why we're here. It's great to have growing revenues, but if it's growing revenues and growing bankruptcy, that's not a good answer. So large companies, mega billion-dollar international companies struggle with it. So do small companies. Where is my profit coming from? Because if I've got limited resources, where am I going to focus it? Where do I focus my people? Where do I focus my time? Where do I focus my investment? Yes, sometimes you just need some revenue to cover costs. But understanding profit is the direction you as the leader need, because if you don't have the direction, you're now abdicating your company to whoever thinks they want to sell. They prefer selling to this customer because they like them. They prefer making this stuff because they like it.
So what kind of decisions do you make that help you increase profits?
It looks at, one of the things I constantly look at now is how do we add more value to our clients? How do we add more value to our engagements? And how do we monetize more of the value that we're getting? Mm-hmm. Part of it is understanding, which market segment do we go after? Do we work very heavily with Vistage? That's been a relationship with ours for a very long period of time. That's an organization where there's CEO coaches putting together boards. Do we work with private equity, where it's a very different dynamic because they've just invested in a company and they're really going to be driving growth? Do we look for large companies, small companies? So part of it is looking at which channel should we be investing in? Where do we have the highest opportunity for growth, revenue growth, and profit growth? And then what's the cost of acquiring those customers? 10 years ago when we started the company, actually the cost of acquiring a customer online was relatively inexpensive. We could do a good job of creating a gumball machine where you put a penny in, you twist it, and a gumball falls out. Well, then it wasn't a penny, it was a nickel.
Right.
Then it was a quarter. Now it's actually, the market is so crowded, it's really expensive to have an effective pay-per-click, revenue generation for the type of thing we do.
So
that's changed over time.
So what are the reports that you look at that help you make those decisions? Vistage versus private equity, for example.
It's looking at cost per qualified lead, and also all the way down to cost per close. So when we get a customer, how much did it take to get that customer? Now sometimes you can't say this one customer.
Right.
In the case of web searches and pay-per-click, in some ways you can. Others, it's over the course of a year, we invested $100,000 in this program, and we got this many clients out. So on average, it cost us X.
The cost to acquire a customer, right?
Yeah.
So you took the totals, sales and marketing expenses for that lead source, right? So,
Exactly.
So by having a custom field in the QuickBooks file that was a drop down that on every invoice you could say what was the lead source.
Where did this come from?
Where did this come from? Then you can run a revenue by lead source,
Right.
and divide it by the cost of that sales and marketing, right? Or divide it by the number of customers you got to
Right.
get your cost per customer.
Yeah, and that gives us one of the answers we need. That's what did it cost to get me. The other answer that you need before that is what can I afford to pay to get a customer? And that has to do with saying, well, with our P&L, if you do the pro forma, if you look at if a customer comes in, what products and services we offer, what type of profit. Okay, if we bring a customer in for $1,000, we can, based on their costs, we can get, let's just pick a number, $200. How much of that $200, can you afford to spend to get a new customer? If you spend all of it, you're not getting any profit.
Right.
Do you spend half of it? Do you spend a third of it? Do you spend, a quarter of it? You need to make that decision up front. In our case, we looked and we said we could afford to spend $5,000 to get a customer.
And what were you looking at? What data?
We were looking at, the average revenue per customer over time. So it's the lifetime value of the customer.
Lifetime value, right?
Yeah. So it's not the first month. It's how many months do they live on
Revenue or
average.
profit?
Well, you start out with revenue.
Okay.
Because we need to look at that. Then backed out. Okay, what's the cost to fulfill that customer, and then what's the cost to to manage the relationships. You have to put in some money in there for the accounting and for the legal and the corporate stuff. So
you're looking at the bottom line net P&L for.
Yeah, I'm trying to get to bottom line net P&L, because if I end up with a healthy gross margin and zero profit,
Right.
Again, that's not a profit gain.
Right.
So
That's fascinating. So what is how do you communicate that data with your team? What is it like inside Chief Outsiders? When you get your reporting package from GrowthForce each month, what do you do with it?
There's two uses of it. Part of it is me to run my business. And I get the reporting package. Quite frankly, I'm also in QuickBooks every day.
Yeah.
Now, I'm not in doing invoices and any of that stuff. That's taken care of. But I am looking at, okay, revenue by this and what happened to this, and okay, this region's down. What elements of the region are down? Within this region, which of the lead sources is growing, which is down?
So we got some memorized reports.
Yep.
That are buttons that you can just click and see the data. So what
Yep.
what are those reports? You're looking at P&L by region?
I'm more often at this point looking at top line revenue per region,
Yeah.
because the first thing that my people can affect is revenue.
Right.
Where's the revenue coming in from?
Yeah.
Where are they focusing their attentions?
Yeah.
So part of what I do is I'll absorb an awful lot of data. I am a numbers geek, and this is a profit game. And I'll determine, okay, of the things I'm looking at right now, these are the most important elements, and this is what I need to share with the organization. So I always share, revenue and with the longer term partners profit, and I share a tremendous amount of detail. But on the bi-weekly, bi-monthly calls with the national meetings, it's specific data based on what do I need them to do. What I found is it's important to set a vision for where we're going and help them understand why getting that vision is important and why getting that vision is good for them. If the vision is let's all make art rich, there's one of us motivated, and that's about it. So the vision is why are we growing the company? Why is growth important? Why are hitting these objectives good for us as an organization? Then it's share the information to allow them to see what's happening. Now I have to admit I'm a conflict avoider. I am not good at holding people accountable. I know a lot of people that are way better at holding people accountable.
I can relate to that.
The conversation I never want to have is sit down with someone and say, we agreed the number was 75 and it's not 75. What are you going to do about it? But you can't lead a company. You can't, have an organization where it doesn't matter if things don't happen.
Right.
So what I do is share the information, rather than me say I am not happy with you, which becomes very personable and just I want to avoid that. Say let's look at the data, but my personal approach isn't one-on-one. Let's look at your data and what's wrong. My personal approach is let's share the data with the organization.
Love it.
And let's talk about the people whose names are on the top third of the chart. Boy, Sharon's doing great. Paul's doing great. Look at this. Isn't it fantastic?
Recognition, right?
And I probably should do more of, so-and-so's not doing good, and but I'd rather leave that empty, because it's the worst thing to motivate people is to do it because they think I need them to do it. I want them to do it. They're being told to do it. The best thing is for them to want to do it, and right in the middle is for them to think the organization wants them to do it. To be embarrassed by, gosh, I got to step up my game.
In my Vistage presentations, I use you as a case study for a company that really understands the importance of making sure that you use the reports, your financial management system, to reinforce your core values.
Yes.
Not to conflict them, because culture eats strategy for lunch. And what I've seen in a lot of cases with some of our clients is the actual key performance indicators and scorecards destroy their culture because they use them the wrong way. Talk about, some of your, you were one of our first clients, right? So back in the early days when we were setting up your system, I came to your management retreat, actually came to your house to sell you, right?
Yeah.
And then, but we sat at your retreat and talked about all the profitability reports we could get, and you're like, I don't want to do that. Do you remember that?
And let me make a minor edit on the statement you made. You said strategy eats culture, or culture eats strategy for lunch.
Yeah.
I say culture eats strategy for breakfast.
Yeah.
Why is that different?
Because the most important meal of the day.
The most important meal of the day.
It's interesting.
Exactly.
Wow. Gotta
culture,
change that.
and I'm happy to talk about culture. But culture needs to be based on strategy. Mm-hmm. The thing that leads culture is the business strategy. Mm-hmm. If those are not synced up, they don't work.
Right.
The culture of being carefree and fun-loving and spontaneous may not be good if you're the Center for Disease Control. Right. And your strategy is not to let the Ebola out.
Oh, Michelle Meixel will love you. Yes.
So the idea is if you need to understand your strategy, what you need to accomplish and why, then develop a culture that can feed off of that. So when the strategy is going well, it's doing that, and when the culture needs to help the strategy, it's doing well. So therefore, when you say, all right, the business is performing or isn't performing, or there's a problem, it's not countercultural.
Mm-hmm. So the example that really struck with me was, this is probably 10, 12 years ago, I was at your management retreat, and we were designing your system, and I said, what we can do is we're going to be able to show you profitability by CMO, right?
Yep.
Revenue minus the costs and the gross profit by CMO. Then we can roll that up. We use classes in QuickBooks, right?
Yep.
Are you still using classes?
Absolutely.
Okay, so we set up classes and subclasses of subclasses. So we went down to the CMO, Then we could roll that up to the city, so you could see profitability of Houston. Then you could see profitability of Texas.
Right.
Then you could see profitability of the central region, right? Because you're nationwide. You got east, west, and central. And then you can roll it up to the company level.
Right.
And then you said, I'm not sure I want to do that. Do you remember why?
And that's because, and it's something I still struggle with, because I now have 5 managing partners. We've got 5 regions,
Wow.
and they manage their part of the business. And traditionally, you would say, well, good, well, they should be focused on gross margin in their area.
Right.
The challenge is in my business, the biggest lever for gross margin, I don't want them using.
What does that mean?
Because the gross margin is the revenue that we bring in from the client minus the cost of the person working the assignment.
Right.
Well, my folks are paid on a percentage of revenue. So the highest cost, the lowest gross margin person is a partner who's a high performer who has really long engagements, because my partners are paid a higher percentage.
Right.
And if they're one of the high performers, they get paid a percentage. And if they have really
High performer meaning what? Top line?
Meaning, no, in the last there's performance programs in the last 4 quarters, they brought home certain numbers, so now
Sales.
they get a higher percentage.
Right.
So then it's sales and it's working, and then if they have an engagement for a very long time, then they get a higher percentage. So technically, my lowest gross margin is when if I put my best person on the project.
Because it's longer term, and it's
Well, I'm compensating them at a higher rate because they've demonstrated, they've earned the role from associate to partner, so they get a higher percentage of revenue share. They've demonstrated they're a very strong performer, so they get another performance bonus, and they have a history of bringing in really holding engagements longer, so they can get. So the lowest margin person I could put on could be the absolute best person for the project.
And so is that to get employee retention? Is that to get client retention? And what's the outcome that you're hoping will happen by that compensation, right? Because
that compensation is employee retention, and it's also it's motivation. People like being in the high performer program.
Sure.
They really
you call it the high performer program.
Oh yeah, they have it every quarter, and it's announced. It's a quarterly thing, and that. So it's the people who are really delivering and driving and building your business need to be compensated.
So the big
so what happened was if the objective of a managing partner deciding who to put on a project needs to be based on who is the absolute best resource for that project. They match the industry background. They've solved that business problem before. Culturally, they fit with that CEO. I don't want them thinking, well, if this new person who just joined the company is paid less, I'll put them on because my margin's better and I'll make my bonus. If one of our higher performing people, a long-term partner, would have been a better fit. So I had to look at which levers to drive profitability do I want them using or not want them using. And so it isn't as simple as
Bottom
pick a
line.
number and bottom line it.
And that's the important message here, right? It's your Gino Wickman in Traction book says what management monitors gets done.
Yeah.
So what do you want to get done? And what you want to get done is you want the right person on the job. The conversation I remember back in your retreat was, you said, if I have a client in New Jersey that needs an oil and gas expert,
Right.
and that person's in Houston, I don't want the Houston manager saying, I'm not giving him up because that affects me.
Exactly.
So kudos to you for doing that. The other big thing that I've always been impressed with in our interactions here is, how you used your MBA in finance and your to create scorecards and what the concept of trailing 12 months and trailing 3 months
Yep.
is to me one of the most important things that's missing in accounting.
Yeah.
Right? The accountants look backwards. I'm now president-elect of the Houston CPA Society, so I can't trash my industry, but management accounting is about looking forward.
Absolutely.
And so you've got some great scorecards that you use for your retreats, and we've incorporated that into our KPI template. Talk about why is TTM and T3M so important, and what do you do with it?
You're absolutely right. In accounting is scorekeeping. It measures what happened. And what you need to do is try and take that information and figure out the future, because the future is actually much more important. You really can't impact the past.
Exactly.
So what we look at is the 12-month rate of change and the 3-month rate of change, because it signals what's happening. If you're just looking at this month, this month could be high, this month could be low. I don't know. It's because of there were more Fridays in this month, or the holiday landed in this month, whatever. This month could be summer, where last month, the other month was spring. So if you're just looking month by month, you might miss things. If you're just looking at the total year, you might miss stuff. There's also, I've got a bias for everything's going to be great.
Optimist, right?
Optimist.
Most CEOs have to be.
Yeah.
Otherwise, you kill yourself.
So it's important to have information that will tell you that'll help you see when things are changing. So the trailing 12 months and the 12-month rate of change says you look at what's the last 12 months of revenue and the 12 months the year before, and what's the percent change. So we'll track, here's my 12-month total, but then what's the rate of change? We're 12% above a year ago. This month now it's actually up to 13, 14, 20, 25. Luckily we've been aggressively growing, and our target is 35%.
Wow.
Year over year growth.
Wow.
It's a challenge, but you've got to challenge yourself. So the 12-month rate of change will tell you over these 12 months versus last 12 months what's changed, and you watch that each month as it goes. But then you look at 3-month rate of change. This last 3 months versus the same 3 months year ago, and you put those on the same graph. So if your 12-month rate of change is here and your 3-month rate of change is lower, that means you're slowing down. Your near-term growth rate is lower than your longer-term growth rate, and your 12-month is going to start dipping. When the 3-month rate of change goes above the 12-month, it means your near-term is faster, and you can start accelerating. What that's done for us is there was a couple of years, where we were growing at 60%, 70%. And you make investments going, you know what, we got this thing figured out.
Right.
We're growing at 70%. We're nailing this thing. And then the 3-month rate of change drops, and you're going, yeah, but
It'll get better.
we got this thing. When the 3-month rate of change starts to really drop, we had to say, oh, you know what? We had taken kind of some of the management team and said, instead of focusing on driving the business, let's do this other project because it feels really good. This is long term, good for the company, but it's not really driving revenue. But it's okay. We can pull some resources aside. We can investment spend in this. When that revenue started to drop, the 3-month, we said, oh, you know what? All hands on deck.
Right.
Everyone get back to selling.
Right.
Let's pull in the dollars, because if anyone out there lived through 2008, 2009,
yeah.
How many people out there who lived through 2008, 2009 wish they had reacted slower?
Right. Nobody. Right.
Everyone says, "My God, I wish if I had seen it, I would have reacted faster. It would have been so much,
Yep.
Death by 1,000 cuts is terrible.
Yep.
Gosh, if I'd known, I wouldn't have spent that money
Right.
2 months ago."
I would've.
Well, if your 3-month rate of change drops below your 12, it means, okay, step back. Things are slowing down. What do I need to stop doing? What do I need to change? If it moves above, it's like, okay, we got this thing going. Let's put a little more fuel on the fire.
So the trailing 3 months is a leading indicator for your trailing 12 months.
Absolutely.
And that helps you, so as a leading indicator means it's helping you predict the future.
Yeah.
Which allows you to get in front of things. I love that. So what do your managers do with the information you give them?
Partly it's intended to be self-motivating, and sometimes that even surprises me. We had one situation where we've been presenting numbers and talking about revenue by this, but not specifically revenue by who sold the deal. It was revenue growth by region, revenue growth by this, and and I was talking to someone saying, I'm really happy with the stuff you're selling. And she said, really? I'm surprised at that, because you've never given me any recognition for it. It was like, what do you mean? Wow. You're my top salesperson.
Wow.
You sell 2x what anyone else in the company says. When there's a new engagement, we send out an email saying, look, Karen got another one, da-da-da-da-da.
Right.
And she said, yeah, but look at the charts you share with the whole company every month. It shows what's happening in the region, but it doesn't show what I sold. It's like,
so important.
So important.
Because in Maslow's hierarchy of needs, right? We all want to be part of something bigger than ourselves, and we need to have that recognition and reward.
Absolutely. And so that person, because of the way they self-motivate, it's like, yes, she loves seeing that chart and that, which is great.
We all do, right?
It is better for her to motivate because she's motivated than do it because I'm telling her.
Right.
And then there's someone else in the organization going, dang, Karen's killing me.
Right.
What do I got to do? I'm going to call Karen and ask, because we do have a good, well, there's not competition because it's a target-rich environment.
Right.
There's so much business in the United States to grab.
Yep.
Nobody's taking business away from each other. You really can say, what are you doing right? How am I doing that? But then, by physically showing the numbers, it allows some people to go, yeah, I got to step up my game, and others to go, yeah, this is working.
So you're growing at 35%. That typically means that you've got operational challenges that affect the bottom line, right? So
Right.
do you find that happening?
Absolutely. We're at a situation now where we need to build out another level of sales force, of a sales organization. The 5 managing partners have been primarily responsible for selling. They can't sell 4 times as much.
Right.
They just can't close 4 times the deal. So
Especially if they're also serving clients.
they don't.
Oh, they don't. Okay,
Yeah.
okay.
But they physically can, and that was an evolution over time where they sold and served clients, and now they just serve clients and manage their team. But so as you grow, and part of looking at the data, you can start seeing, well, when are things flattening off, and they don't all flatten off together. But is by understanding what's happening in the data and region and why, and saying, boy, this area's been growing like crazy. Why isn't it growing as much? And then you start to realize, well, gosh, this rock star is tapped out. We need to develop another level of organization below them to support them. We need to, to look at how do we, which of our product lines are profitable. Well, we're providing a service. We often think about it as a product line.
Yeah.
Doing due diligence to help a private equity firm is different than doing consulting for the CEO of a company. That's different than doing a competitive analysis. So
you've productized the services.
we've productized the services, sometimes primarily in our mind, not necessarily in the client's mind.
Right.
But we're able to look at where do we see the opportunity for more profit? Where are we seeing the opportunity where a client's saying this is great, but it could be better? And then how do you build out that?
So what kind of decisions are you making? We talked about investing in marketing campaigns, Vistage versus private equity, for example. But what other, do you look at your gross profit report or profit and loss by customers or by CMOs? Do you do anything with that data? Do you figure out some clients you have to fire?
Our business is a little different because my cost of goods fluctuates with top line. My chief marketing officers are paid a percentage of the project.
So your gross profit is locked in as a percentage?
Depending on who works it.
Right.
Again,
right.
As one of the things we recognized is, and this again is looking at the data, we put in this high performance program. We said, well, if you make this much over the last 4 quarters, for the next quarter, you get this extra. And we did that at a time when 18 to 20% of the people were hitting that number. Well, fast forward through a few years, last quarter last year, 65% of my people hit that number.
That's a great problem, though, right? That's because that's what you wanted.
Well, that's a great problem, but now that actually takes profitability down. Sure. Because it wasn't a high performance program. It was just a profit,
sharing,
a profit sharing program. So we had to say, if this continues, if a higher percentage of my folks are partners, and everyone's in the high performance program, we've now taken down our margin by 5 full points.
Right.
Because that was 5% of top line for that.
Yeah.
So we had to look and say, okay, well then let's redefine what high performance is. High performance several years ago was this and this level. Now that we've got this much built in the organization, we have to redefine what high performance is. So the metrics helped us get there. We also looked at at regions and different types of customers. It's much more, it takes a lot more for us to bring in a private equity company for the first time. But if we do a good job, then the next ones roll real easily.
Right.
And over time, the cost per lead comes in much lower.
The customer acquisition cost. So you're using your data to drive the compensation program, which is one of the most important decisions that you're going to make, right? Pricing is number 1, but comp structure is number 2. Yeah. And that's very interesting.
And comp structure affects profitability and culture and motivation. And if you have good people, they really want to work. They really want to do well. And they'll do what you pay them to do. So be very careful what you're paying them for.
So do you have budgets and forecasts, and you lay that out as goals and say, here's our target for the year?
Yes. Yeah.
So let's talk about that.
And the challenge there is there's the art target. There's the aggressive growth, and then there is the more realistic target. Over our 3-year average has been 35%.
That's great.
But that was 60%, 35%, 15%.
Ah.
So, how do we get from 15 back up to the 35?
Okay.
I don't know that we can get back up to the 60s.
Well,
I don't
it's a bigger
expect
number
that.
too, right?
It's a bigger number.
So.
But if we sit back and say, this is pretty comfortable. I'm making okay money. You make good money. We make it. Yeah. Are you guys happy? Good.
Right.
That doesn't work. Companies don't stay the same.
Yeah.
So, one of the challenges is reminding the organization, is growth important to us? Not for me, but for us.
Right.
Why is growth important?
Right.
It's important because we have deeper relationships. We can bring in better engagements. We can more fully utilize people, put them on better projects. I have to continually explain to the organization why growing the company is good for us and them.
For them.
So that they are motivated to help grow.
Right.
But then there's I'm putting a big number out there because I want you scrambling to figure out how we're going to get there. Oh my gosh, I don't see how I can get there in my region. Okay, well then what do we have to do different? What are we going to do different this year than last year to hit that number? If you're going to do exactly the same, we'll get a little better results, but let's constantly look for what are we going to do different, what are we going to do differently. And because of my background, I love to say our strategy should be the same for several years. It's not a soup du jour, not du jour. This is the strategy. This is where we're focusing our resources. This is what we're making happen. And while we're doing that, we're testing 2 or 3 other things, because in 2 or 3 years, we're going to say, all right, now the new strategy is this one that we tested for 2 years, and it's ready to really drive. So while we're focused on this, let's figure out some of this other stuff.
So, we got a lot of listeners here who are at different stages of their business life cycle. And we've been through them all, right, with you, right? Various times. Talk about how you started looking at the numbers when it was just you, right? You had to decide, do I go get another job or do I start a company? If I remember correctly, right? That's how most people start. That's how I started my job, right?
I had been unemployed for over a year at that point, so it was early 2009, and yeah.
So we were 4 years ahead of you. I thought we started at the same time. So back in those days, you were doing it all, right? Let's talk about kind of how you've evolved to, now 2009, 10 years later, you've got 5 managing partners, but
and 70 people.
And 70 people, yeah. Right? So walk us through the changes that happened from startup to emerging to growth to mature.
It's been a fun ride. It's been a wild ride. I refer to an entrepreneur as a visionary with a poorly developed sense of risk. It's like, this is going to be great.
Oh my God, I can relate to that.
I got this vision. This is going to be great. We can do it. We can do it. We can do it. And I started out by doing everything. Yes, I was out selling. I mean, it was me and one other guy,
right.
And I was working the engagements. And I wish I had kept it, but I had this. The bank gave us this big checkbook. Mm-hmm. With these little long checks and the stub over here, and you wrote the check and it's like, now here's the balance, here's the balance, here's the balance, and those were our books.
Right.
It was a book. That's why they call them books.
Right. You were keeping the books.
I was keeping the books.
The book.
Yeah, it was one book, and I was writing the check. And once we started to scale a little bit, and me doing an invoice in Word and saying, hey, thank you, emailing out an email saying, thank you, please pay me this much. Trying to make an email look like an invoice, said, well, that doesn't work. So that's when we looked at QuickBooks, and that's when we first actually brought you in, and then one of your people, and just said, can you help me set it up? Let me explain my business to you. how I think it'll work, how I think it'll grow, how I think I'm going to compensate people, and and literally, you came to my office, my home office. One of your people came, installed it on my PC, and sat there with me for 2 days, saying, all right, here's your revenue accounts, now here's your expense accounts, now here's how you make an invoice, here's how you email it, here's how you bring it.
And how to make it look professional with your logo, and the custom fields on there, so you can track, we work backwards from the decisions you wanted to make, right? In fact, that was our very first conversation. You're like, people tell me I need to talk to you about QuickBooks. Like, okay, you got to start by making a list of the decisions you want to make,
right? And
then we'll work backwards from there to figure out what are the drivers of those decisions, and then we can figure out what data you need.
Yeah, and what's fun is I still use that data from 2009.
Amazing.
I still, when we show the charts twice a month, here's the rolling 12, here's and it goes all the way back to there.
And so you started as a startup.
Yeah.
With, it was a really sophisticated accounting system, made simple, and it was very inexpensive to get started, right? I mean, it was a couple $1,000 tops, right? Because you didn't have
it was less than that. Because I didn't have a couple $1,000.
Yeah, I mean, because when you do it every day, it's fast.
Yeah.
And so you were a QuickBooks consulting client, and we're still doing that now, except it's virtual, right? So our clients are nationwide. So those 2 days or 3 days that we spend is through Zoom video.
Works.
So then we gave you, so you could just go do the bookkeeping yourself, but inside QuickBooks. We showed you how to do that.
So I did it for a while, and then, quite frankly, my people got frustrated because I'm not the best bookkeeper. I'm not the best accountant, and I learned when you mess up someone's paycheck, it kind of bothers them.
Sure does.
When you calculate it wrong and you don't pay them the right amount, or they now are worried about the last 5 checks they got, and they got to go to see if I did it right. Not because I was cheating them. No one thought I was cheating them. It was just like, you messed up. Right. When you mess up on invoices to clients, it kind of affects the professional look and feel of the organization. When your job is to call that client that hasn't paid, and you're a conflict avoider, that doesn't happen.
And you want to maintain a positive personal relationship too, right?
Absolutely. So what happened? These were my dollars. This was my company. This was my business. These were my dollars. I wanted to control it.
Right.
I understand finance. It was difficult for me to first let it go. And I have to admit, the first couple attempts weren't as successful. We were using an accountant, a CPA.
So you went to your tax accountant.
My tax CPA.
Your tax CPA.
Yeah.
And you said, okay, you guys could do bookkeeping, right?
Yeah. Do you have someone who could do this?
Right.
And handed it off. And they were really good people and everything, but that wasn't their business. That wasn't the thing they did. They did it better than I did. That's for sure. But not to the level needed, because it was an interruption to their job.
Right, especially in tax season.
Yeah, especially in tax season, and it's like, but I really need these invoices sent out, or because at that time I was sending out the invoices, and I was having the checks mailed to my house, and I was depositing the checks that I would email them saying, I deposited these checks, process it and process the payments for my people, then I'll log in and authorize the payment. But you're right, during tax season, during this and that and the other, and it was one person.
So you had a single point of failure. If that person's out sick, that bookkeeper quits.
Yeah. And there's also so at that point the question was, well, then do we hire our own? Because this is my dollars. I need to control this. I need to understand this. I need someone I can trust. Control. The problem with that many businesses face, they don't realize it, is if you have one person, they're responsible for sending out invoices, taking in payments, paying vendors. If they're the
reconciling bank accounts.
Yeah, money coming in, money coming out, reconciling the bank account, telling me what we made or not. It's just open for fraud. It's I'm sure everyone hires really good people, but thousands and thousands and thousands of businesses get hammered with them. And it's a well-meaning person that says, gosh, if I just had an extra $5,000 in my checking account this month, just for this month I could pay that credit card bill and I'll put it back next month. And I didn't mean to, and I didn't want to, And
they won't miss it.
they won't miss it, yeah. So I didn't want to go down that route because I'd read about that route. I had people in my business group who had had a problem with that, of, having to get, why was Betty never took vacation? She was such a great worker. She had 4 years, never a day of vacation. Oh my God,
The cash is gone.
Yeah.
The average theft, I just did a ebook on this. The average theft in small business is $200,000, and it takes 18 months to catch them. And 95% of the people who steal from businesses are first-time offenders, meaning they're not crooks, they're good people. But when you give them the keys to the vault,
Yeah.
and they have a personal situation, a family member that's sick, or a husband loses a job, or whatever, then temptation's too easy.
This company makes millions. This is just 10 grand this month. I'll put it back.
Right.
So what we recognize is moving to GrowthForce. We've got a team of 3 people. We've got one person who spends a lot of time on it, and their stuff is checked, and their stuff is checked, and there's not one person who's bringing in the money and paying out the money. I'm the only one who actually pays it out.
Good.
I get an email from Kyle who says, Art, there's bills to be paid, and I log in and I look at it, I go, yep. Surprisingly, it's one of the best parts of my day.
I know.
I am giving money to my friends.
Yes.
It's like, I just paid out $150,000 to my friends.
I say that all the time. I love writing commission checks.
Yes.
And on Bill.com, it's so easy because you have a scanned image of the bill. You can make sure that it's your AT&T bill, not the somebody else's. And you click a button.
Yeah.
You can do it at a traffic light, and then your QuickBooks file is automatically updated. Yeah. I love that. So we took over some of the bill payment.
Yeah, and
what was that like? You gave up control. I mean,
I gave up control.
Did it get better or worse, or what was it emotionally?
And at that time, I said, well, I still didn't want to give up sending out invoices because I really wanted to keep a handle on that. So we gave up some of the control, and I told my folks, this is going to be a challenge. We're doing this. Expect some roughness. They're not going to get it right the first time.
Bumps in the road.
Bumps in the road. And what you guys did is you did once we agreed, you did a full month of doing it without actually doing it.
Onboarding.
Your onboarding process was, while the other accountant's still doing it, you're doing it as if you did, and let's see if it came out.
Well, we were automating, right, and documenting and recording, looking at processes and flowcharts, and then saying, okay, here's a better way.
Yeah. So when it came through, when we turned on the switch, it actually went perfectly, no issues.
Yeah.
And within a year, it said, okay, then you guys even do the invoicing. We figured out a way where we send a setup form to you, and your people say, all right, now I know how much to invoice and that. What was funny is we do have a national meeting once a year. We bring everyone into Houston for a full week of training and such. And we had your folks stop by that first year. And if you remember, I've got about 35 people in the room, and I say, okay, I'm going to introduce you to somebody none of you have ever met, somebody I have never met.
And you're in Houston, right?
And I'm in Houston.
It's all virtual.
I've never met them. You have never met them, but I know you already love them. And I brought your team in, and people are standing there looking at these 3 people going, and there's obviously a more senior person, a mid or junior person, and I go to the junior person and says, "This is Kyle Wakefield," and the room exploded with applause. They stood up. It's like, yes, you're the guy who gets our paychecks right.
Yes,
you're the guy who gets my invoices right.
Yeah.
You're the guy who.
We take it personally. We become part of the team, right?
Yeah.
And what I love is when I go around to Vistage events and I see the CMOs, I meet them at the trade shows, and people I've never met, I come up and say, "Hi, I'm Steve King with GrowthForce, and thank you for being a client." It was like, "Oh my God, that was the best decision we ever made."
Yeah.
One of the things I find really fun that's I think worth sharing is how we do your billing and collections is very different. I was an Inc. 500 speaker, and I did a survey of the best practices of the Fortune 500 in cash management. And what I found was a process that we use for you, which is your first call for collections is not 30 days after the bill is done, overdue. We call your client as soon as the contract is signed and say, "Hi, I'm Kyle. I'm the accountant for Chief Outsiders, and my job is to help make sure that it's easy for you to receive and pay our bill." And we walk through the process of who's responsible for paying the bill, what kind of supporting documentation do they need, is there any approval process? The bill is due on the 15th of the month. If I get it to you on the 1st, is that enough lead time? And
Yep.
and that solves all the collection problems because you get all the issues out before you start the work.
Yeah, and it dovetails into our client onboarding process, because when we onboard a client, the first thing they do is they get an email, a really nice PDF that says, here's how to expect to work with us, and here's Kyle, and there's a picture of Kyle.
Yeah.
They get a picture of Kyle.
Yeah.
Kyle is, with GrowthForce, they do our bookkeeping. Here's his contact information. Here's the W-9. Here's all da-da-da-da-da. But they get a picture of Kyle. Expect to hear from Kyle.
Right.
And boy, if we can get the first invoice paid on time, the others flow.
Exactly right.
That first one, if it's like, well, it's 30 days late, and then you call and oh yeah, we didn't ever set you up in the system. Yeah.
Right.
Can you give us a W-9? Yeah, well, we sent that to you 3 times already. It was on, So proactively onboarding a client can solve so many things.
And so what did it do to your cash flow? When you let go of this, right? And,
Yeah.
and this is the biggest concern people have, what did it do when all of a sudden you had somebody else doing it?
Quite honestly, it was liberating.
Mm-hmm.
The only person really, the only one, I wouldn't say person, the only one really disappointed was my dog.
Why?
Because it used to be every day I'd go, oh, get the mail, get the mail, the mail's come. I just saw the mailman come out, and the dog would, yeah, and we would run out to the mailbox and go, oh, look, I got a check, oh, we got a check, oh. But now the checks are mailed to you, my dog's like, wasn't that the mailman? Don't we get to run outside and get
That's
excited?
so funny. I love that.
It's liberating to me to know that it's being done. I mean, we've scaled quite a bit. We're sending out 100 invoices a month. There's just no way that I could be doing that. My time is better spent somewhere else. Artie McFerrin, one of the guys who was in my Vistage group, great guy, great CEO. He said one of the most important lessons he learned as being a CEO, and it's something that I try and do every year. He said the first year he started his own company, and he said, I was doing really good $100 an hour stuff. I mean, I was doing $100 an hour stuff. So I had to look and figure out, was there any $75 an hour stuff I could stop doing so I could do some $125 an hour stuff? And he go, well, then the next year it's like, well, you know what? Is there any $100 an hour stuff I can stop doing so I can do some $200 an hour stuff? There's some $300 stuff that I want to do. I'm going to have to figure out how to get rid of the $200. Time he said, Art, I don't do anything that's not $2,500 an hour.
Wow.
And I'm like, yeah, right. And then I realized, well, he started his own company. The chemical engineering school at A&M bears his name. The athletic complex bears his name. The indoor track stadium, the baseball field, and the entrepreneur center.
Wow. That's a role model.
That's a role model. And it really is. Each year I looked and I said, what am I doing that is $100 an hour, that's $200? What do I need to stop doing? It can go to someone else in my organization. I can outsource to someone else. But so that I have time to do the higher value things. Mm-hmm. And quite frankly, opening checks and driving to the bank and calculating commission checks, yep. and that was not the highest value thing I could do. When I handed it off, 1, it got better, less errors. 2, there was more control. 3, when I said, I'd love to figure this out, can you help me figure this out? Someone who really knew QuickBooks was able to go, yeah, we can pull a report on that. I can do that. You want that automatically each month, or do you want that something you can pull up and play with? Versus me trying to figure out how do I do it. So we never could have got where we are today, scaling the way we are, unless I hired a whole team. And I never could have afforded a whole team. And that team wouldn't have had a career path, because you're the bookkeeper in a small marketing firm. Where do you get promoted to?
Right.
There's not who trains you, who keeps you sharp, who keeps you motivated.
Right. And so you're not going to get the best bookkeepers because they're not going to build a career, and we do. You said one thing, a last thing I'll just say here, I thought that was really interesting, is that you told me once, you guys helped take a fixed overhead expense, accounting, and turn it to be variable, and just in time. I would have had to hire a controller a year before I really needed it or could afford it, and you guys were like, all right, turn on billing, all right, turn on controller.
Yeah, how many people do I need to send out 30 invoices? Well, a quarter of one.
Right.
And then I got all this fraud control thing. Instead, I got 3. How many do I? Oh, look, we're up to 50 invoices. Look, we're up to 60. Look, we're up to 100. I haven't had to hire and scale. We each year, you and your team, I get together with your team. They say, well, then this has come up, and I'm going to say, what can we do to change the process, procedures? What can we do to lower some expenses? What do we do to add? Yeah, the number we pay you goes up each year, but we also figured out things that, this is really inefficient the way we're doing it. If we change it this way, it'll be more efficient.
Right.
Good. So it doesn't have to go up as much.
Right.
So this cost increases have not increased at the rate of sales,
right,
or increased at the rate of invoices.
Right. Because we want a client for life, right?
Yeah.
We're not looking to maximize each month. Well, Art, I got to tell you, this was a lot of fun. I appreciate you as a friend, as somebody I admire, as a client, and as an advocate for GrowthForce.
Yeah.
And I didn't expect that we would really talk about how you need both a financial management strategy and a human capital strategy in order to run better, grow faster, and make more money.
Yeah.
And I applaud you for taking that MBA brain, MBA in finance, and starting a marketing company, right? Everybody would assume that you were, a degree in marketing.
Well, I went from being the finance guy and the new products team at Frito-Lay to marketing Frito-Lay.
Ah.
So I was on the Sun Chips test market team.
Cool.
And then from Frito-Lay new products to Kellogg's new products in Battle Creek.
Wow.
Froze my little tail off.
Right.
Then to Coca-Cola.
Right.
So I've been in marketing a long time, but it's a profit game.
Yeah.
This all comes down to profit.
Mm-hmm.
Whether you're a marketing person, whether you're building a manufacturing firm, a service firm, it's a profit game.
100%.
And if you don't know what part of your business is driving the profit, you don't know where to direct your people.
Mm-hmm.
And for me, being able to say, here's why profit is good, here's why growth is good, and then give them the numbers where they can self-regulate, when they can self-motivate, when they can self-analyze. That's just better for me, because I'm not going to sit down and go through it with people on what are you not doing well, why isn't it working,
and then recognize and reward those people who contribute the most to profits.
Yeah, visibly, recognize and praise, and I just don't happen to comment on the others.
Well, thanks for sharing all that. I appreciate you coming today.
Thank you.